All right, let's get into your pro picks now. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick is Aris Water Solutions. This one you hinted at. If you want to play on growing energy consumption, is it that people should think about all the water that is required to be part of that story?
Yeah, and so Aris at its core is a water handling company for Permian oil and gas producers. And so this might be surprising to your listeners, but in West Texas, particularly, you have the Permian Basin. And so the Midland Basin was the eastern portion that was developed first. The Delaware is deeper and more complex on the west side, and it runs up into New Mexico, which is where a lot of Aris's assets are. But for every barrel of oil equivalent, which has parts oil, parts natural gas, and then parts liquid petroleum gas, so things like ethane and butane and propane. For every barrel of oil equivalent, there might be 4 to 5 barrels of what's called produced water that comes out of that well. If you think about the hundreds and billions of dollars of infrastructure in the Permian Basin dedicated to handling oil and gas, 5 times that is going to be required for handling this water. And so with Aris's network, basically what they're going to do is right now they're making most of their revenue by handling this produced water and then recycling it into these disposal wells. As the industry matures, they're recycling more and more of this, which is creating higher and higher margins because you're basically earning more margin on the same barrel of water that you're taking away and getting paid to take that away from the well site. This is also looking at different types of desalination technologies where you could actually use it for things outside of the oil and gas industry, one of which would theoretically be this liquid cooling and then service in these power generation turbines. There's also pilot strategies, technologies in iodine extraction and other types of trace metals. And so there's a lot of different ways that Aris can grow throughput, pricing, margin, and other types of new emergent revenue streams on the existing asset base, which, as it stands today, is earning about a 20% return on invested capital, even though it's running at about 60% capacity.
How much upside do you see? It's trading at $24.
So it's trading about 10 times operating cash flow today. And this is a company that's grown revenue at a 30% CAGR since IPO a couple of years ago. So even, I'd say, modest execution on growing top line and margin, this business should trade at 15 times. So if they could grow their cash flow 20, 25, 30% over the next 18 to 24 months, and then they get rewarded as they should with a 15 multiple, you're not doing mental acrobatics to see a doubling here.
Thank you for doing that for us. Sometimes our guests just leave that for us to do the math. So a possible double from here. You talked about how much you like exchanges, and that extends to TMX Group in Canada as well, which of course is the owner-operator of the Toronto Stock Exchange. But it's so much more than that, right? It really has evolved to being like that data company, and does have big derivatives exposure as well through some of its recent acquisitions.
Yeah, so as I mentioned earlier, I think they're dominant in Canada. Where between the TSX and the TXX Venture, they have over 65 market share in Canada. But that's for listings and capital formation and equity trading, which is still a good business. I would say that the really interesting business, which is, let me check my notes here, about 30% of revenue is this derivatives trading and clearing. And so they have the Montreal Exchange. They also have a really interesting business called Trayport in DataLink, which is European energy. So you'd never think that the TMX was controlling a lot of wholesale power trading when European power prices were blowing out a few years ago because of gas prices. But when you think about the entire ecosystem of the TMX, you have the transactional revenue around these derivatives that we're structurally positive on with margin and with clearing. You have the capital formation of TMX and TSX Venture, which on a low base, I think has room to improve. And then you have the data and analytics with businesses like Vetify, where they bought Vetify, I think, to really try to grow the ETF business. And so the ETF business is enormous in the US. Canada's catching up, but you'd be shocked at how early stage in Europe and other parts of the world, ETFs are just an afterthought. And so I think there's a lot of green field ahead for the Vetify business to continue to grow ETFs worldwide, but also through the TMX ecosystem. And so one thing about exchanges is because they're such great business models, they aren't the cheapest. TMX trades around 20 times operating cash flow, but we think in the right market conditions, they can grow that sustainably high single digit, low double digit. Very good at bolting on acquisitions. There's definitely some room for margin on top of that. And so we think of this as a sleep well at night compounder over the years where you're not going to get rich quick, but you'll get rich slowly.
That was going to be my question. You took the words out of my mouth. Is valuation. If I hear any bear thesis around TMX, it's the valuation. So you kind of answered that you just kind of put up with it. Your last one is more in the commodity space. We haven't talked too much about energy. We've talked about you being bullish on gold. So your third pick is Prairie Sky. Obviously, with oil prices plunging, now hugging around the $60 per barrel mark, this is an interesting play. Do you have conviction that oil prices are going higher? And we know you prefer royalty plays in general. So is that why you're positioned in Prairie Sky?
Exactly. I mean, first and foremost, you just can't replicate 18 million acres of royalties in the Western Canadian Sedimentary Basin. And as you mentioned, with oil price volatility, it's very painful to be in a producer that needs 65, 70, $80 to make an economic return. I mean, people throw out all these silly numbers about break evens that are using kind of fairy tale math, but there's not many companies that are earning robust margins and can earn their cost of capital in the 60s, which is why we own it through Prairie Sky as a royalty, where they earn 60, 70% margins as just kind of clipping royalties off the top. They, as of right now, are exposed to, let me see here, nearly 30% of capital expenditures in the Canadian energy industry that you're basically getting a free ride on through a royalty vehicle. But so back to your point about energy and energy prices, I think that if you're willing to look through the noise, unfortunately for the world, hydrocarbon demand, mostly gas, but still certainly oil, is upwardly sloping to the right. You've seen a dearth of investments worldwide. We'll see as OPEC gets their barrels back onto the market. But the world has been investing and positioning for a world where we hit peak oil now. I mean, there were people in 2020 that said 2019 was peak oil consumption. The decline rate of conventional reserves worldwide is 6, 7%. Shale is multiples of that. And the lack of investment over the past decade around this incorrect thesis of declining demand and obsolescence around hydrocarbons, it's going to catch up with us. And I think once we clear the extra OPEC barrels, we'll see what happens with with whether or not there's a recession. Nobody knows what's going to happen with China, but I think structurally, unless there's a very severe left tail event with demand, we're not going to have the hydrocarbons to balance the market. And it could be as early as 18, 24 months. And maybe that'll be what catalyzes a more rapid transition to different types of fuel sources. But we're of the belief that we're going to continue to grow probably until about 2030 in terms of global oil demand. But then there's going to be a very long plateau that the world is not properly prepared for. And that's mostly around non OECD countries where we in the West are asking them, you do as I say, not as I do, where we're saying decrease your energy consumption intensity, whereas we're many multiples of India, China, Southeast Asia. I mean, forget Africa, sub Saharan Africa. And so the industrialization of that part of the world is going to keep that consumption elevated for many, many decades. And so I think we're very positively inclined to that right tail beyond kind of 1 to 2 years.
Okay, so that's looking beyond a potential slowdown in the US. The stock's pulled back about 27% from its recent peak. What kind of upside does it go back above 30, or is it like do you see new highs?
I think there's going to be a lot of volatility around. You can never escape, even though you're insulated on a margin and a free cash flow conversion standpoint. You can never escape the sensitivity that you ultimately do have around the oil price sensitivity. I think that the market is very delicate at this point. 60 does not work for OPEC because even if their wells technically break even in the 20s, if you add in the fact that they have to fund their entire government and social programs, Saudis probably need 90 to 100 to not be dipping into reserves. Some other countries are lower, some are higher, but you're also not going to see U.S. shale as much as we want to say drill, baby, drill. And I have a very high opinion of Chris Wright, the Secretary of Energy in the U.S., who formerly ran a fracking company. He should know darn well nobody's going to be adding capex and adding rigs at 60. And so the situation could correct itself before you know it. So I'm of the belief that there's definitely skew to the upside. But I do think that as people look to play an eventual recovery and they want to own that through a quality modality with a very robust dividend and a lot of safety, Prairie Sky is going to attract a lot of eyes.
All right. Thank you so much, James, for your insights and for all of your ideas. We appreciate it so much.